Most people think mutual funds are the safest place to park their retirement money. They're simple, diversified, and managed by professionals. What could possibly go wrong? But here's what nobody tells you. Some of the most common mutual funds in 401k, and IRAs are quietly setting retirees up for disaster. Not because they're obviously bad. In fact, they often look smart on the surface, steady performance, familiar names, built-in diversification. But hidden underneath are dangerous flaws that most investors never catch. Outdated risk models, excessive fees, poor diversification. And by the time you realize it's a problem, you've already lost time and money that you can't get back. With 2026 around the corner, the decisions you make right now could determine whether your retirement is comfortable or chaotic. That's why today, we're breaking down 7 types of mutual funds that could quietly wreck your financial future if you're not careful. If you've ever trusted your plan just because it felt safe, this might be the wake-up call you didn't know you needed. At first glance, a 1% fee doesn't sound like a big deal. It's barely noticeable, right? But when it comes to mutual funds, that small percentage can quietly cost you tens, even hundreds of thousands of dollars over time. High-fee mutual funds are one of the biggest hidden threats to your retirement, and most people don't even know they're paying them. These fees are often buried in the fine print under terms like expense ratio or 12b1 marketing fees. They don't show up as a separate charge. Instead, they quietly reduce your returns year after year. And the worst part? The performance of these high-fee funds doesn't usually justify the cost. In fact, many of them underperform cheaper index funds, yet still charge premium-level fees. Let's break it down. If your fund earns 6% annually but charges a 1.5% fee, you're really only gaining 4.5%. That gap adds up fast, especially if you're drawing from that account regularly in retirement. You're not just earning less, you're also accelerating the drain on your portfolio, and most people never notice. They think they're on track, but the erosion is happening silently in the background over 20 or 30 years. High fees can eat away 6 figures of your total wealth. That's not a rounding error. That's a ruined retirement plan. Target date funds sound perfect on paper. Pick the year you plan to retire, and the fund automatically adjusts its risk over time. More aggressive when you're younger, more conservative as you approach retirement. Set it and forget it. Sounds ideal, right? But here's the catch. Not all target date funds are built the same. Many follow outdated glide paths that no longer reflect today's economic reality. Some are far too aggressive, keeping a heavy stock allocation even as you near retirement age. Others swing too far in the opposite direction, shifting into bonds too early and missing out on crucial growth years. And since these funds rebalance automatically, you have no say in how they adjust. You're locked into a preset formula, one that might not match your real risk tolerance, income needs, or lifestyle. Even worse, some target date funds are loaded with fees and low-performing sub-funds. So, while you think your money is being managed wisely, it's actually sitting in a bloated structure that costs more and delivers less. Many people treat these funds like cruise control, but what happens when the car's programmed route no longer matches the road ahead? You get caught off guard. That's exactly what could happen by 2026 if your target date fund is steering you in the wrong direction, and you don't even know it. The word index fund gives people a sense of comfort, as if anything with that label must be safe, broad, and reliable. But not all index funds are built alike. In fact, some of the ones sitting in your portfolio right now might be tracking a market that's far riskier or narrower than you think. Many investors assume an index fund means total market coverage, but some of these funds only follow a small slice, like mid-cap growth stocks, niche international sectors, or volatile emerging markets. And when those sectors take a hit, your safe investment suddenly becomes a roller coaster. The real danger is in the label. The word index gives you a false sense of diversification. You think you're spread out across the market, but in reality, your exposure is concentrated in a tight corner that can swing wildly with economic shifts. And it gets worse if you own multiple index funds that track similar sectors. You're doubling down without realizing it, riding the same highs and the same crashes, thinking you're diversified when you're really just overexposed. Don't let the name fool you. Just because it says index doesn't mean it's low risk. And if 2026 hits with another market shock, the wrong index fund could leave you reeling and wondering why nobody warned you sooner. Most people never question the mutual funds inside their 401k. After all, they were selected by professionals, right? And if your employer set it up, it must be the smart choice. But here's what no one tells you. Those default 401k funds might be quietly draining your future. When you're automatically enrolled in a retirement plan, your money often lands in the default fund, usually a generic target date or balanced mutual fund chosen by your employer or plan administrator. You didn't pick it. You probably didn't even look at it. And that's the problem. These default options often have bloated fees, uninspired performance, or investment strategies that don't align with your actual retirement timeline. Worse, they're built for the average employee, not for you. That means your goals, your risk tolerance, and your retirement timeline are completely ignored. And over time, that mismatch can quietly sabotage your progress. You might be taking on more risk than you're comfortable with, or not enough to keep up with inflation. Either way, your money isn't working the way it should. The trust you place in your employer's plan could be costing you tens of thousands without ever throwing up a red flag. So, if you've never reviewed what you're actually invested in, now's the time, because by 2026, that default could be the difference between a smooth retirement or a stressful one. As retirement gets closer, most people instinctively shift their money into bonds. It feels safe, stable, and responsible, the traditional move to protect what you've built. But if you're heavily invested in bond mutual funds right now, especially the long-duration kind, you might be sitting on a ticking time bomb. Here's why. Bond funds don't behave the way most people think. When interest rates rise, like they have been, the value of existing bonds drops, and that means bond mutual funds can lose money even while the economy is stable. In fact, 2022 saw some of the worst bond fund losses in decades, blindsiding investors who thought they were playing it safe. And then there's inflation. While you're earning modest returns, maybe 2% to 4% annually, inflation quietly eats away at your buying power. You're not just treading water, you're slowly sinking. That monthly income from your bond fund might look fine on paper, but in real life, it buys less and less each year. Many retirees believe their bond-heavy portfolio is a fortress, but when rates rise and inflation surges, that fortress starts to crack. If you're counting on bond funds to carry you through 2026, it's time to double-check what they're really doing, because in this market, safe might be anything, but some mutual funds earn your trust early on. Maybe they had a great run a decade ago, or they were recommended by a financial advisor you respected. So you stick with them year after year, assuming past performance means future security. But here's the uncomfortable truth. Many of these once great funds are now quietly dragging down your portfolio. Fund managers change. Strategies shift. What once made a fund a top performer can slowly fade without any warning to you. And unless you're actively monitoring it, you'll never notice the decline until your annual returns start falling short of expectations. Loyalty to an underperforming fund is one of the most common and costly mistakes retirees make. It feels safe because it's familiar, but that familiarity can blind you to slow, steady underperformance that quietly drains your long-term growth. And the longer you wait to make a change, the more ground you lose. Many investors stay stuck, simply because they don't want to deal with the hassle of switching. But doing nothing comes at a cost, a hidden tax on your retirement dreams. If one of your mutual funds hasn't outperformed its benchmark in years, it's time to ask yourself a tough question. Are you holding it because it's still a good investment or because it used to be? By 2026, that distinction could be the reason you retire on time or not at all. On paper, your portfolio might look diversified. You might own 5 or 6 mutual funds across different accounts, a mix of large cap, balanced, international, maybe even a few sector funds. But dig a little deeper, and you might be shocked at what's really going on. Many mutual funds, even those with different names, often hold the exact same top stocks. Apple, Microsoft, Amazon, Nvidia, these companies show up over and over again across all kinds of funds. So, while you think you're spreading out your risk, you're actually doubling, tripling, or even quadrupling down on the same assets. This kind of overlap creates a false sense of diversification. When the market is up, everything looks fine. But when tech takes a hit or a single company stumbles, your entire portfolio can drop in sync, even though you thought you were diversified. Most investors never check under the hood. They trust that owning multiple funds equals balance. But in reality, their retirement is riding on just a handful of companies. That's not strategy, that's exposure dressed up as safety. If you're planning to retire in 2026 or soon after, now is the time to dig into your fund holdings. Because when the market turns, and it will, the last thing you want to realize is that all your eggs were sitting in the same basket, just wearing different labels. The real danger in retirement isn't always what you see, it's what you don't. Mutual funds are marketed as simple, reliable, and low maintenance. But beneath the surface, many are quietly underperforming, overcharging, or leaving you overexposed in ways that could derail your plans before you even hit 2026. And the worst part? Most people never look. They trust that because something worked in the past, it's still working now. But retirement isn't a time to guess. It's a time to know. Maybe your fees are too high. Maybe your safe bond fund is bleeding value. Maybe your portfolio is a house of cards built on overlapping stocks and outdated strategies. Whatever it is, the time to fix it is now, not when the market crashes, not when inflation spikes, and definitely not when you're already living off those withdrawals. Because a secure retirement doesn't just come from saving enough. It comes from protecting what you've saved and making sure it's working as hard for you as you work to earn it. So take a closer look. Ask better questions. And if something feels off, trust your gut and investigate. You've still got time to make changes, but you won't if you wait until the damage is already done.